right, I think we got a couple people joining us right now as well. But we can go ahead and get started. I want to respect everybody's time here. First, I'll do an intro of myself. I am Bill Gogel. I'm a senior manager at Armanino. Armanino is a public accounting firm based out of San Francisco. I am particularly based in St. Louis, Missouri, part of the ISACA St. Louis chapter here, and have presented to them before. And pleasure to present to your chapter. In my role, I do a lot of cybersecurity and PCI compliance. So I've had to learn a lot about the payment card industry and how it all works and how they handle security and all that other good stuff. So yeah, I do assessments, audits against the PCI standards. So we'll talk a little bit about the standards today, but I really wanted to focus on how that whole payment ecosystem works. So it's a little bit of behind the curtain of how, when you swipe your card, at a merchant, what happens behind the scenes, right? And then what's all the security in place to protect that data? So that's really kind of what the focus is here. But I will talk about security PCI kind of towards the end because I am talking to a group of auditors. All right. So just kind of the agenda for today, kind of broken up in 6 parts here. We'll talk about the history of credit cards, which I found was super interesting. The main players, the whole payment life cycle, security PCI, some frequently asked questions I get as a subject matter expert in this area, and then kind of debrief at the end and answer any questions. And speaking of questions, feel free to put those in the Q&A or the chat. I've got them both open and I'll be answering them in real time. Or if I think it might be better answered towards the end, I can certainly address it then. So, all right. So let's jump in. Talk about why did credit cards exist? Well, it's basically just credit on a card, right? It's a credit card. So it follows the same financial principles of trading on credit, but with 2 big differences. These cardholders, that's me and you, are pre-approved for credit lines. With that comes high interest rates and things like that. It also benefits merchants. It's easier for them to collect payments and it's quicker. And sometimes it's, it eliminates cash from the situation or from the transaction, which, there's a lot of cost involved with handling cash and protecting cash. I like to think of a little bit of a cynical person, so I like to think of who's winning and who's losing in this situation when it comes to credit cards. So some of the winners obviously are the banks and the credit card companies or the card brands. They make money on transaction fees and things like that. And also to an extent, as a consumer, it's a bit of a win, right? So I don't have to carry cash around. And I've got this card that can be used globally. So that's pretty neat. On the downside, credit cards, they're not free to use, right? There's a high cost, especially if you're not paying down your monthly payments. Those fees and those interest rates do add up. So there's been a lot of revolving credit card debt here, lots of bankruptcy. So kind of paints a picture of the winners and losers. I'm sure I didn't capture every single player in this, but this is kind of how I see it. Quick timeline of payment card industry of how we got here today. So, I mean, you could go really far back if you want to talk in terms of what credit is and when credit started. But I wanted to kind of put the stake in the sand of let's start in 1885, where we had our first paper loyalty card. It was closest thing to a credit card today. And then 1949, we had Diners Club. And then 1958, we had American Express come out. And that was really, I mean, Diners Club was really the first credit card. or modern version of the credit card had an account number, had a name. I think the account number was 4 digits, right? And then American Express came around and wanted to get into that game. And American Express is quite a unique card brand. We'll kind of get into why later. And then we had Bank Americard, which eventually became Visa. So this was started out of Bank of America, was the bank that started this, and they eventually released their grip on the brand and let it be its own thing, and it eventually became Visa. Around the same time in the 60s is really when that boom started. So Visa was first, then MasterCard, originally called Interbank Card Association, and then you had the Japan Credit Bureau, or JCB, at the same time as well. JCB is kind of the fifth payment card brand in this. They don't operate in the US as far as I know anymore, but they are a global player. So just like any new financial instrument or financial product, soon came regulation. There was a lot of no control over interest rates and how to issue credit cards and who deserves a credit card and things like that. So in the 70s, you saw a fair amount of regulation, things like the Fair Credit Reporting Act, the Equal Credit Opportunity Act, for example. And then in 1985, we had Discover. So this was our fourth at the time credit card company. So we had Visa, MasterCard, Discover, and JCB. Or sorry, it's the fifth. American Express came in 1958. And then in the 2010s, we had a big boom in payment technology. We had EMV chips, and then we had contactless payments. To this day, I use tap technologies on my phone as much as I can. It's just very convenient. I don't even have to carry a card around anymore. It's pretty neat, and it's actually a more secure form of payment than the card itself. And we'll get into why all that is later. All right, so who are the main players? And I think this is really important to understand, like who everybody is in the payment life cycle. So you have the card brands, right? That's Visa, MasterCard, Amex, Discover, and JCB. You also have acquirers. These can also be called a merchant bank. So these are banks that fund the merchant. So if I run an e-commerce store or a brick and mortar store, it's my bank that is collecting or settling funds for credit card payments. Then you also have issuers. So these are banks that issue credit cards. So Visa and MasterCard, they allow banks to issue their credit cards. So for example, Chase is a big issuer. They issue lots of Visa and MasterCard cards. You also have service providers. So these are, think of the kind of the technology stack or technology providers that make this huge ecosystem work behind the scenes. So those could be like payment processors, gateways, and other technologies. Then you have the merchants themselves. So the storefronts that are taking payment for services or goods. And then lastly, we have the cardholders, which is you and I, people that are holding the card in their hands. All right, so let's start with the card brands. So let's talk about like who the biggest players are here. So Visa and MasterCard, as you can see in the graph on the right, are by far the two largest. Amex coming in third, and then Discover pulling up kind of the rear in the American or the North American market. Again, JCB doesn't do a ton of business in the States. Yeah, it looks like they ceased operations 2018. So let's talk about Discover a little bit. This was actually birthed by Sears, right? It was, I think 1985 was the year it was birthed. So it was very appealing for consumers because they didn't have any annual fees, had higher credit limits. And those weren't features that were really around for the Visa and MasterCard cards that were issued by banks. And they were the first to really introduce cashback bonuses, which was really appealing to cardholders. And then you had Amex, of course. It's more of a premium card brand that really focused on small business or, small to large size businesses. I'm going to back up one slide to talk about the issuers real quick. So an issuer is any institution that issues a card, right? So when you look at this list, Visa and MasterCard are not issuers. They don't issue their own card. They let the banks handle that. And the banks set the interest rates and things like that. Visa and MasterCard, they're just a network. They don't set interest rates or loan terms. Discover and American Express, on the other hand, they are both issuers. So they issue their own cards. So they're kind of a technology company plus a bank, right? Visa or MasterCard are a little different in that way. Acquirers. So these are, again, the merchant bank. You're gonna, if you're gonna accept payment cards, you're gonna need a bank to help facilitate that transaction. And you can see on the graph on the right here, it was hard to find any figures beyond 2019. So what I've got here is the top acquirers, and this is a rapidly changing industry. Tons of merger and acquisition activity in 2019 and continuing till today. So FIS, Chase, First Data, those are probably the three largest acquirers out there today. So really, the acquirer is there to facilitate a payment, right, on behalf of the merchant. Typically, the merchant enters into some sort of agreement with that acquirer on the terms and fees and things like that on accepting those payment terms. And I'll talk about fees a little bit later because I get a lot of questions around why are credit card fees so high, and you'll kind of see why. Not trying to offer opinion on whether those fees are fair or not. That's a pretty controversial topic, but I'll present the facts as best I can. So these acquirers are typically also partnering with a bank to fund the merchant. So like WorldPay, for example, they partner with Fifth Third Bank for small merchants. And so for the larger merchants, they might use a different bank. So WorldPay is also a giant acquirer. So yeah, once the merchant is signed up, the acquirer ships them all the needed equipment and provides professional services for installation. So if I'm a coffee shop, for example, and I just want to take card payments, or maybe I'm cashless as well, I want to take card payments only at my little coffee shop, I'm going to call up WorldPay and they're going to send me all the equipment and set me up, right? So yeah, the way acquirers make money is they charge fees to the merchant. It's usually a combination of fixed fees and then transactional fees as well. And then you also have the merchants. So I talked about the coffee shop, for example. There's really two ways to take payments as a merchant. So you have card present. So that is a physical swipe, dip, or tap of the card. So that's your traditional brick and mortar store. Then you have e-commerce transactions, which are considered card not present. There's also other ways that payments can happen. You can always pay by telephone, pay by mail. Those would also be considered card not present. So if I'm, going to donate to some nonprofit and they send me a form to write my credit card information down and mail it back, that is card not present. Merchants are also the front lines for credit card fraud, and I'll talk a lot about fraud later. So they do bear a responsibility of keeping that whole ecosystem secure. There's newer payment technologies that reduce that burden on the merchant. Because if I'm a merchant, I don't I just want to sell product, right? I'm not a security expert. Please just send me the device and the equipment and let me run my business, right? So that's the interesting balance that a lot of these payment technologies have to meet, is a balance of security and usability. And then you also have the issuers. So we talked about this. I've got kind of a graph here of the 10 largest issuers. Chase is a large one, the largest, and then you have Citi and then Amex, Bank of America, really make up 50% of the market. So the issuer, again, they're issuing physical credit cards, or in some cases even virtual credit card numbers. So they issuers are supplying cards branded by Visa or MasterCard. So like, for example, I have a couple of Chase credit cards and they're branded for Visa. And what that means is they're leveraging the Visa network for that payment technology. So in some cases, financial institutions are going to be representing both the merchant and the cardholder. Like Chase would be a good example here, right? Or even Amex, for that matter. They're going to represent the merchant on one end and also the cardholder. Then you have cardholders. That's you and me. You know, the way credit card companies and banks make money off us is those annual fees and then interest on monthly balances. So typically when you get a credit card, you know, you've got these elements. There are some things you can certainly see on the card, and there are some things that are invisible on the card. So we all know the primary account number, right? So for Visa, MasterCard, and Discover, that's a 16-digit number. For Amex, it's 15 digits. Also have an expiration date. And then a CVV, CCV, or a PIN. So that's a security code associated with that. So think of it as almost like a two-factor authentication in the world of InfoSec, right? It's a similar idea there, is having that code. Typically that's on the back of the card, and that is particularly for instances where somebody might be able to take a photo of your card, the front of your card, but they won't have that 3-digit that's on the back, right? And that's to prevent some of the over-the-shoulder ATM spying that some folks are subject to. So also with that credit card, and this is on either the mag stripe, the magnetic stripe that's on the back, which is, you know, slowly starting to disappear and becoming less common, or on the chip, right? That EMV chip on the front of the card. All this information is stored on both those elements. So we got the name, and then track 1 and track 2. So track 1 and track 2 are really just kind of, think of it as row 1 and row 2 on the mag stripe or on the card, or sorry, on the chip. So I talked about these as credit card data elements. It's the same thing for debit cards and gift cards. Not all gift cards are credit or debit cards, but a lot of them use Visa or MasterCard as a gift card. All right, then next you've got service providers. This is a huge industry. I've kind of got this bulleted out on the different kinds of service providers, and this isn't even a complete list. But I did want to talk about a little bit more detail later of what a payment processor is, what a payment gateway or switch is, and what a payment facilitator is. They are very easily confused, but perform very different things. But also, you know, people like hosting providers or outsourced call centers, they're considered service providers in this ecosystem. All right, so the next series of slides is really walking you through a payment lifecycle. So I'm going to try to keep this slow and try to recap as much as I can, because you can get lost in the details here. So there's really 4 steps to this, 4 large steps, and there's some like sub steps below that. But basically, step 1 is authorization. So that's what I'll talk about here. So how I've got this constructed here is I have the card holder across the top. That's like me, right? I've got a Chase Visa card. I want to buy coffee from my favorite coffee shop here in St. Louis, which is some coffee. Me as a card holder, at the top there, I've got an issuing bank, right? So that's Chase in this case. And then it's also a Visa, so that is the card network behind my card. And then across the bottom, you have the merchant, which is the coffee shop, and then the merchant's bank, which is Square in this example. Square is a little bit unique in that they're both an acquire and a merchant bank. So they don't, as far as I know, they don't partner with any banks to do all their funding and settlement and all that other stuff. So that's kind of how this is constructed. So I'll have arrows kind of pointing to all these different parties to explain how a single transaction works. All right, so obviously I want to pay for my coffee, right? So I'm gonna dip my card into their point of sale machine, right? So reads my EMV card, or I can tap. Either way, it's all gonna hit that merchant system. So that's step 1A there. Then moving on, it's gonna kind of wrap around to the acquirer and then the card network. So the merchant needs to make sure that this is a valid card, right? So is this card expired? Are there enough funds on this card? What sort of guarantee am I going to get this payment, right? That's probably something the merchant wants to know, right? Because essentially I'm presenting them a token of payment, right? Or a promise of payment. And they want to make sure that I can fulfill that promise. So step 1B here is really the merchant communicating with their merchant bank, which is Square, and then also checking with Visa to make sure that my card is valid. All right, next step, merchant needs to make sure that there are sufficient funds. Visa doesn't know that. Visa doesn't keep track of my balance. The merchant bank or the coffee shop's bank, it has no idea if I have sufficient funds. But who does know is Chase, right? They know my credit limit and my my balance, whether I have exceeded my credit limit or not. So that merchant bank, they're gonna contact Visa, like you saw in this previous slide, and say, okay, who does this card belong to? Who's the issuing bank I need to network with or interface with to see that they have a valid balance? And that brings us to this step right here. So Visa's going to say, you need to go contact Chase to figure out if this cardholder has enough funds. So that's this step in the authorization process. All right, so once Square gets comfort that Chase says, okay, yes, this cardholder has $5 for this coffee, and we promise to pay you. The payment processor then submits an authorization request to the card network, which then submits the authorization request back to the issuing bank. So now we're at the issuing bank still. The issuing bank's going to approve or decline that authorization. So, and by approve, it's saying, yes, you have the money, or no, I don't have the money. And then communicate that all the way back to the merchant. So this is all happening in like, a split second, right? So when you first dip that card and it says authorizing, this is what's happening during that whole process. So it's got to make its way all the way back to the merchant, say, yes, we approve this transaction, or it's authorized. And that is that very last mile of when the merchant gets the thumbs up saying that this card is authorized, that moves you into the capture phase. So that's kind of step 2 here. So the merchant is guaranteed payment and the funds are captured. Capture is not really the reading of the card details, but it is saying that the funds are set aside for this particular transaction. That doesn't mean the funds are available right away. It is saying we have set aside funds to send your way later. And the reason they do that is they batch these up at the end of the day, right? So they don't want to, that's a lot of traffic to do individual transactions or to send. It's expensive to send a high volume of payments to another bank, right? So they'd rather just batch it up at the end of the day and send that to the merchant bank. So it's really like a temporary hold on your card that goes against your credit limit. All right. And then phase 3 is the settlement. So the merchant wants to get paid, right? They don't truly have the funds from the cardholder yet. So the issuer deducts that purchase amount from the cardholder's account. So that $5 comes out of my balance. And the acquirer is going to send a batch of outstanding payments to the card network, who sends that on to the issuing bank. So Square knows that it's expecting $1,000. They had a great day. And they're going to contact all these issuing banks, Chase being one of them, and say, you owe me $1,000 because I have this list of transactions for you for the day. And so Chase validates that on their end, saying, yep, that matches our records. Here are the funds. We're going to deposit these funds into this account right away. So let me back up here. So this means the funds are available to the merchant, right? And for a lot of small businesses, cash is king, right? So the quicker that they can get funding, the more attractive that is for a merchant, because that means they can, meet payroll and pay rent, things like that. And then the fourth potential phase is a chargeback. Now, this is not common, right? A chargeback is doesn't happen in every transaction. It is only when there is a dispute. So if I look at my credit card statement, for example, and say, I got double charged at Sump, I shouldn't have been double charged, or that they maybe added a tip on that I didn't authorize adding a tip on. I dispute that with my issuing bank. So I go on the Chase's website and say, this is not an accurate transaction, or it's a duplicate transaction. Issuer is going to review that, determine if it's worthy of investigation. And typically the issuing bank works for their cardholders, and that they will side with the cardholder in most cases in these disputes. They're trying to keep you as a customer, so they're going to side with you as a cardholder. So the issuing bank's going to reimburse the cardholder right away, usually. So it's going to give me $5. So then what the issuing bank does is, if it thinks it's worthy of investigation, it's going to go to the merchant bank, or the bank for the coffee shop, and say, hey, cardholder thinks that there's an issue here. Here's the evidence they provided. Here's the evidence that we have on the transaction. The burden of proof is now on you to prove that this was or wasn't a duplicate transaction. So that burden is put on the merchant in the merchant bank now. And that burden, it's quite a burden for the merchant bank to deal with all these. And so they'll typically charge a fee to the merchant for this dispute. And the reason is they're trying to incentivize the merchant to capture accurate transactions, or to incentivize them to not have duplicate transactions or fraudulent transactions. So from here, the acquirer is going to notify the merchant. The merchant has to provide receipts or video footage, even sometimes, of whether that was truly a duplicate transaction or a fraudulent transaction. In some cases, like, let's take this one, for example, it's a $5 transaction. Is it really worth the time of the merchant bank or the merchant to go investigate this for $5? For $5, I mean, I don't know their thresholds, but I probably wouldn't go chase this, right? I just pony up the $5 and pay that to Chase. That was the merchant bank. So in this case, this process is really prone to fraud, right? So even if it's a low dollar transaction, this type of fraud is called chargeback fraud or dispute fraud. So there's been a lot of improvement in payment technologies to make sure they kind of minimize this likelihood. So say the merchant does have compelling evidence, they're going to send that back through the channels, back to the merchant bank, through Visa, through the issuing bank. And then sometimes that ends up in arbitration. For $5, it's not going to be arbitrated, but if it's a large dollar transaction or whatever, it might. So yeah, that's kind of the recap of or the whole payment life cycle. So in my example, I used a Visa card, right? I also wanted to show how that works with Discover and Amex. Since I mentioned earlier, Discover and Amex are their own issuing bank. So there's no Chase, there's no Bank of America, right? So this is what kind of the picture looks like for Visa and MasterCard, right? You have the card network out to the right, and then you have the issuing bank, Chase, at the top. If we look at Amex and Discover, they are both the card network and the issuing bank all of a sudden. So it does take out kind of a middleman here. And I think they, have a cost savings there on their end, and are able to offer like services and perks and benefits because they don't have issuing banks to deal with. All right. Looks like we're on time here. And if you have any questions, again, drop it in the Q&A or the chat. I'm keeping an eye on it. I also wanted to go over some merchant models. So there are lots of ways you can take payments. And this is really kind of let me back up to one slide back here. When we talk about issuers, or not issuers, I'm sorry, service providers. I had this bulleted list of all these service providers of things that services to support kind of the card network, really, or the security of those cards. So there's lots of players in this arena. There's always lots of mergers and acquisitions in this arena, so it's really kind of hard to keep up with. But if you're a service provider, you have to enter some sort of agreement with Visa or MasterCard. If you want to be part of their network, there are certain security requirements you have to follow, certain agreements that are in place for, if anything goes wrong or whatever, right? And then in what capacity are you working with Visa and MasterCard on their network? So to really understand that, there's a couple different merchant models, or actually there's 4 merchant models. And I took Visa as an example because they're, again, one of the largest players. And I think a lot of other card brands kind of follow their example. So if you want to be a service provider, you enter into their third-party agent program. Their TPA program has really 4 different categories of how you can work with Visa and MasterCard. You have ISOs, or independent sales organizations, payment facilitators, third-party services, and merchant services. So those are the 4 kinds. I'll go over these in brief here. So if I'm an ISO and I'm a service provider, all I'm really doing is I'm a large merchant, or I'm trying to get large merchants into the door, and they bring their own payment technology. So I'll take, for example, like I wouldn't be a middleman for like Gold's Gym, for example, right? It's got lots of franchises, lots of locations, and I want to be able to connect them to Visa and MasterCard for payment processing. An ISO would be a really good fit for that. They're a large merchant. They have lots of different payment technologies. And that also means like me as a service provider, I don't have to touch any of that cardholder data, which is great from a security perspective. I'm just being a middleman or connecting, basically reselling Visa and MasterCard services in this situation. Secondly, we have payment facilitators. So this gets kind of go up the scale in as far as burden of payment responsibility or security responsibility. So payment facilitators are good if you're like a smaller medium merchant, and you don't want to have you don't have complicated requirements for getting up and going. So maybe a small merchant with 2 locations, I just need to accept credit cards at my 2 locations. Send me that technology, and also can you handle some of the compliance requirements for me since I'm a small merchant. So typically those small and medium merchants are paying for that kind of service, right? It's a little more white glove in that sense. And that also means the risk transfers, there's a large amount of risk transfer, not complete risk transfer from the merchant to the payment facilitator. This is, the way this works is there's really kind of one master merchant ID account between the payment facilitator and the card brands. So what that means is under that merchant ID, the payment facilitator assumes all risk, and they're signing up sub-merchants under that ID to process payments under that. And I have a little diagram later that makes sense of this. So interesting, this is probably the fastest growing area in the payment card world is the payment facilitators. And where this usually works is in industry specific. So, in the nonprofit world, there may be a handful of payment facilitators that specialize in nonprofits and donations and things like that. You also have third-party services. These are typically a payment processor. There are dozens of different kinds of third-party services, but a payment processor would be probably the most popular. And these are the ones that are actually doing all that authorization, settlement, capture. Those are the ones that are really facilitating those processes. Then you also have merchant services. So like a payment gateway. A payment gateway is really for e-commerce transactions. So that's card not present transactions. So say I'm an Amazon.com, right? I'm providing a payment gateway between like a stack of technology to connect payments to the network and to different banks. Payment switch is really similar. Payment switch is really for card present payments and like a franchise situation. All right, let's do a deeper dive of payment facilitator since this is probably the fastest growing area. So a lot of modern e-commerce platforms are payment facilitators behind the scenes. So if you think of like Shopify or Squarespace and you're just a one-person shop, right? And I just want to sell my goods on the internet, like an Etsy or Shopify or whatever. I am engaging in their services to handle those e-commerce payments for me. So that would be an example. But the problem, I've got a kind of a problem solution situation going on here. And it did really solve a problem in the industry several years ago. So for example, you have a nonprofit merchant who wants to use their legacy fundraising software to accept online credit card payments. That software probably doesn't have a native integration or doesn't have the technology to accept e-commerce payments. So a lot of these payment facilitators can offer that platform to connect that legacy software to a e-commerce payment site, for example. And so they've got some sort of customer off-the-shelf integration that works with that. I talked a little bit about merchant IDs before, so this is kind of how the merchant ID setup works. So let's keep going with our nonprofit example. The biggest one by far is Blackbaud. So Razor's Edge would be an example of one of Blackbaud's products. They're a cloud-based platform that offers a full vertical. It provides a GL, donor relations, and it also accepts payments. Everything just kind of works out of the box. So Blackbaud offers this platform to a lot of nonprofits, right? It's a very attractive product for nonprofits. So behind the scenes, Blackbaud kind of has this their own payment gateway, which is a technology stack to accept e-commerce payments. And then you also have the software. Razor's Edge is truly a payment facilitator, and also holds the master merchant ID. So any merchant or sub-merchant I sign up under Blackbaud gets a sub-merchant ID or a sub-mid. So an example of that might be like Girl Scouts or United Way. So Girl Scouts wouldn't be able to accept e-commerce payments. Same with United Way, and those kind of go out to the donors, right, to accept those payments. So you can see that the flow would be, right to left here of donors and making a donation to Girl Scouts, rolling up into Razor's Edge, and then off to Blackbaud Merchant Services for processing. So it might be better to visualize kind of how the traditional model works from a payment facilitator model. So in your traditional, or what I would call the ISO model, the independent sales organization model, is typically a merchant. So let's take United Way, for example. The merchant's going to directly engage with an acquiring bank and get funding and transactions through there. That's totally fine, but it kind of means that United Way has to go shop for a technology stack to offer e-commerce payments. And that's where the payment facilitator model helps as e-commerce payments are growing every year. So United Way might be one of several sub-merchants that engages with a payment facilitator. In this case, it would be Blackbaud. And Blackbaud is the middleman that has the agreement with the acquiring bank there. So you can see it is truly like kind of a middleman, and that middleman assumes a lot of risk. And that's going to be really attractive for some of the merchants that sign up under that. And when we talk about risk, it's really a security risk and fraud risk, right? And so security is a pretty big topic in the world of credit cards, right? There's this whole ecosystem of security. The reason, obviously, is to drive consumer confidence that we can securely use these cards, but also make it easy to make payments. So that it's, as people who work in InfoSec know, that's a really hard balance to have, and you have to involve a lot of parties to find that balance, because you need to balance that usability with security. That usability is going to be on the end users, right? So you need to get insights and opinions from those end users of what would cause too much friction for my cardholders to use their card at my shop, for example. So rewind a bit. There's a problem. Let's see, before 2006, each card brand had and still has their own card security program, and I kind of listed them here below. I won't read all of them, but they roughly accomplish the same thing, right? And this made it really confusing for merchants. So if you're accepting Visa and MasterCard in your shop, you might have two different compliance models you have to deal with and two different parties to report to. That's not a good experience for a merchant that just wants to sell coffee, right? So what they came up with was, all these card brands came together and formed a council, and that is the Payment Card Industry Security Standards Council, or PCI, right? I think a lot of us have heard of PCI, especially if you work in the world of InfoSec. So at its purest level, it's a set of security standards that all merchants and service providers, issuers, everybody in that payment lifecycle that they have to follow. So what's interesting is the Security Council, they are a governing body, right? They set the standard. They set the standard to, they set the standard to, the 200 something requirements that everybody has to follow. They don't enforce the merchants or service providers to do it, but they're just drawing up the standards. It's actually the acquirers that are responsible for enforcing these standards. So let me back up a bit. On the service provider. Let me find the right slide. Here we go. So you can see like the acquiring bank, they engage in a contract with the merchant. So that acquiring bank is really responsible for that merchant's compliance. So the credit card companies put it on the acquiring banks to do that. Oops. The council is influenced by a lot of participating organizations and special interest groups. That comprises of merchants, so the coffee shops, the Targets, the Home Depots, etc. Service providers, payment processors, security vendors, and assessors. And I am not on. I've not been involved with participating organizations, but the idea here again is to have full representation from the whole ecosystem to understand what is the right balance of security and usability with this kind of technology. Oops. And here's a snapshot of kind of the whole ecosystem, how it works. So you probably, as like InfoSec people or auditors, we probably are most familiar with data security standards, which is kind of right there in the middle, or DSS, that's that report on compliance or attestation of compliance, self-assessment questionnaires, that sort of stuff. That's actually just one piece of the whole ecosystem. You've got other standards like payment application standards. So if you're a developer that makes a payment application, like a Square, for example, you've got to follow some secure standards. If you're a facility that produces physical cards, there's a set of standards on how to securely do that. And then also, again, more standards if you develop some sort of platform or secure software on how to design that stuff so it's compliant with the standards. And then you have all the assessor programs on the left, so people like me who are trained on how to do some of these audits. Here's a quick peek at some of the secure technologies that are out there. So EMB is one I think a lot of us are familiar with. That's the chip on the card. The chip is interesting. It really only provides authenticity to the card, right? So it is a unique identifier to that card. So it makes it hard to replicate the card physically. The flip side of that is that card was, or the chip can be compromised and it can be duplicated now. It's just very difficult to do it. So the cost of doing that for a lot of criminals is high. So it disincentivizes them from trying to duplicate that. You might remember before the chip came around, it was very easy to duplicate a magnetic stripe on a card. You can just read that data and then almost like copy and paste it to a new card. And so that's what EMB that problem was trying to solve was, let's make it hard to replicate a card. That chip does not encrypt anything on it. So when you dip or insert the card into a machine, for example, that chip doesn't provide any encryption. It's just authenticity. It's some fancy cryptography that validates that card is authentic. You also have point-to-point encryption. So basically, this is a secure tunnel between a card terminal and the payment processor. So the secure tunnel makes what used to be a public circuit into a private circuit, and it removes a lot of the risk from the merchant. Very popular technology. Most of the card readers you see out there today are probably using them. If it's, within the last 2 or 3 years, if they've been implemented or upgraded, you're probably using that technology. When I do assessments with my clients, I'm making sure that they've at least looked at this when they're looking for new payment technologies. It removes a lot of PCI requirements. You also have, things like contactless payments. I like this technology. It's actually uses a lot of really cool cryptography behind the scenes and encryption to make sure that, one, that data can't be wirelessly intercepted. And then when it gets to the payment card processor, it creates kind of a one-time token that can be used. So it's really difficult to steal any card data because it uses this fancy cryptography to, one, be able to identify me as a cardholder, know how much to take out on my card, and which merchant to charge that against. So pretty neat stuff. You also have tokenization. So this is really for e-commerce environments. So if I'm shopping at Amazon, it is creating a token of my card number, which makes it useless to criminals. So that token is, I don't know, it's like a 36-character GUID, if you're familiar with that term. It's just a random set of numbers and letters that is randomly generated using an algorithm that both the payment processor knows and the card terminal knows, or not the card terminal, the e-commerce software knows. Then you have 3D secure and hosted payment elements. I won't go into detail for that because they're a little less popular right now. But lots of secure technologies that have been created to really incentivize merchants to kind of release their grip on cardholder data, because we're in a world now where no merchant really needs to store cardholder data. And if you don't need to store it, you shouldn't keep it because that creates a lot of risk. So if you can outsource some of that risk to somebody, which is a lot of what these technologies represent, that's great for the merchant. All right, so getting to the last few slides here, I had a couple FAQs to answer. Let's see, check on time and questions here. Looking good. So what's with all the credit card fees? I get this question a lot. Here's just a preview of some of them. This is not all of them. It doesn't even talk about some of the interchange fees that the networks like Visa and MasterCard charge, which is kind of the more controversial area, especially when it comes to small merchants. But generally, you've got monthly fees, transaction fees, things like that. So typically transaction fees are what the merchant has to pay to accept that transaction, right? So it's usually a flat fee plus a percentage of that fee. And I've given an example here of like 2.9% plus 30 cents for each transaction. Per transaction, that that may not seem like a lot, but when you add up thousands of transactions, you can see how the banks make money here. And these are fees that banks charge to the merchant. This is not what the networks like Visa and MasterCard are charging. We talked about that chargeback fee already. PCI compliance fee. So if a merchant is non-compliant, the acquirer is looking at that saying, oh, geez, that's a really big risk to me. I'm going to get fined, or I'm going to have to bear the cost and burden of a potential breach because this merchant's not compliant. Therefore, I'm going to try to fund and make an insurance fund, basically, from this merchant, and they're going to pay a higher fee because they're non-compliant. So when the breach does come one day, I'll have funds set aside to remediate that breach. So it's an incentive to get merchants compliant and on to newer, more secure technologies. Then you also have equipment leasing fees. This varies a lot. Acquire to acquire, sometimes that the acquirer can offer that equipment for free. Sometimes it's, 20, 30, 50 bucks a month or something like that, or a year, to rent that equipment. Most people are not paying for their own equipment because the payment technologies are evolving so quickly. It makes a lot more sense to kind of lease it. So generally, like having a cell phone, right? You're replacing it every 2 or 3 years. Might make the investment, but I think for the most part, we all do buy our own phones. So what did EMV do for the merchants? So this is they called it the liability shift back in whatever year that was when EMV went into effect. So before, if there was a breach, before EMV, if there was a breach, the acquirer bared the burden of those costs. So what EMV did was kind of shift that liability onto the merchant of, hey, if you don't adopt this new secure technology, we're putting you on the hook, or we're going to pass on those costs of those breaches to you. So this was just kind of a way to get merchants onto chip technologies. And I think, it's very rare that I come across a merchant today that is not accepting chip payments, right? I think everybody's doing it these days. So that was, in a nutshell, kind of what EMV was trying to do there. Lastly, the other question I get is, what happens if I run a debit card as a credit card? And that, I think that's such an interesting question, because again, it goes back to the network. When we talked about Visa, MasterCard, Amex, Discover, they are a network, right? They're not a bank. Well, Amex and Discover are, but they basically connect all these banks and all these merchants and all these parties to make sure a transaction goes through. So when you run it as credit, a credit card as credit, it goes through those networks, right? All the networks we're familiar with. But if you run it as debit, it goes through a different network. And those networks, for example, might be Pulse or Star or Interlink. And there's different features between all those different networks. So basically the short answer, it doesn't matter if you run it as debit or credit, but you are offered more protection if you run it as credit, because that's what the bank is providing, is some fraud protection. So that's really, really the big difference there. Oh, I guess we're at the end. Oh, right on time as well. If you got questions, I didn't see any questions come through. If you do have any questions, you got my email on the screen there. Hopefully you enjoyed this presentation. And I think I'll hang on for maybe a minute to see if any questions do come through, but feel free to hop off if you have any. All right, not seeing any questions come through, but thank you for the compliments. I will go ahead and end the webinar here. Thanks for attending.